Hi, everybody, and welcome to TradeStation. For our special event today, we're pleased to have with us Christian Tharp, CMT, the Chief Market Strategist for the Adamesh Trading Group, for our webinar this afternoon on trading decisions and the ETF market. TradeStation special events are live streaming webinars hosted by industry experts and leaders from around the world, and our topics include a wide variety of key international and domestic financial trading issues, opportunities, and trends. So we're very happy to have with us Christian Tharp to help us meet that goal. Christian Tharp was the first full-time coach at Adamesh Trading, and he's had the opportunity to share his experience within the area of stock and options trading with well over 1,200 students. He has a decade of expertise in the area, as well as his CMT designation from the MTA. He's knowledgeable and communicative, and we'll turn things over to him in a moment. Our presentation is for educational purposes only. All the symbols and trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Please keep in mind that active trading may not be suitable for you because it's not suitable for everyone. And options trading carries a high degree of risk and is not suitable for all traders. We've posted in the chat panel 2 different pieces of disclosure information regarding characteristics and risks of standardized options and other important disclosures. Also in the chat panel is a PDF that contains the upcoming TradeStation webcast. So please take time later after the presentation to download those items and take a look at our offerings. Which brings me to our presenter today, Mr. Christian Tharp of the Adamesh Trading Group, and he's going to talk to us about trading and trading decisions in the ETF market. Welcome, Christian, to TradeStation.
Thank you, Don. Thanks for having me. Always appreciate the invite to speak to your audience. Especially when it comes to ETFs and our own money cycle service, which is about research and trading of ETFs in the market. And so it's always great to be able to speak to the audience and show them a little bit of the way that we look at things and we do things over at the Adamesh Trading Group. So thank you to everyone. And I tell you, one of the first things I always try to do, when I do any presentation for any audience, is kind of let them know a little bit about me. Obviously, Don has already done part of that heavy lifting for me, but I think it's important when you're attending a webinar, you want to have some sort of confidence that the person you're listening to, may or may not know what they're talking about, right? So, as Don said, I guess at the core, I am a professional stock market coach. I have been coaching for the Adamesh Trading Group pretty much since inception of the Adamesh Trading Group, about 10 years now. The actual number of students I've coached is a little over 3,000 students in I think it's somewhere over 30 different countries around the world. And that doesn't count the members. We have several different trading services. Money Cycle is kind of our flagship service. But when you look at all the members within our service that we also do a little coaching for, it is certainly something north of 4,000 people. So why does that matter to you? Well, I always like to say probably the most valuable information that I have that I can share to the students and members that I do coach is that I've learned from my students that I've coached. You learn a lot. You hear a lot of the same questions, a lot of the same struggles. And so being able to relate and relay, the solutions to those issues is something that is probably just as beneficial as anything else, right? So 5-Star Trading Academy, you see that listed there. Why is that important? Without getting into it, at the Adamesh Trading Group, and specifically in my coaching and running our services, we subscribe very much to the keep it simple process. Trying not to reinvent the wheel. Our belief is that simpler plans are easier to follow. They're easier to stick to. with discipline being the hardest thing in the market, it's a lot easier to be disciplined if you have a very simple plan that you can easily follow day in, day out, week in and week out. The 5-Star Trading Academy is just something that was written a long time ago that we still share with all of our students and members, because it kind of maps that out over 100, 110 pages, and the importance of it. Today's Big Stock, your article I write every day, again, keeping it simple. Daily Trader's Edge, it's one of our content sites. And then lastly, being a chartered market technician. I get asked quite often, what that does or does not mean. I say, well, it doesn't mean I know everything, that's for sure. World of technical analysis is a big, big world. It's changed and it's grown since I became a CMT. Definitely since I, became a trader in the market and started coaching. I always like to say it just means I know a little bit about a lot of different things. When you look at the run-of-the-mill retail technicals and technical analysis, those things, yeah, probably an expert. So when you think of candlesticks or trend lines or moving averages or Fibonacci or whatever the case may be, a lot of that mainstream stuff I could certainly bore you to death on, but we won't. All right. So that's a little bit about me. And as I mentioned, been with AMTG for 10 years, pretty much Adam's right-hand man, his chief technical analyst and his head stock coach. All right. So that's that. Let's talk a little bit about the webinar agenda for today. I'm going to keep it relatively simple, just kind of talk about some meat and potatoes about ETFs, sticking mostly with what we do when we are researching ETFs to make trading decisions for our money cycle service. Certainly isn't, the end and be all any which way you could get into the ETF analysis and selection, right? But definitely it is, I'm going to shed some light on what we do. All right, so we'll talk a little bit about just what ETFs are. Certainly, all of you that are attending this webinar, I'm sure span the gamut: beginners, intermediate, advanced. Most of you may know what ETFs are. Some of you might not. So certainly want to be thorough, talk a little bit real briefly about what ETFs are. And then when you look at the money cycle, the two biggest things we do to make, for an ETF to make our list, to get on our radar, is we like to see which ones the big institutions are buying or selling, getting into or out of, which ones, are kind of got the wind at their back, so to speak. We also like to look at which ETFs are performing best. And certainly if we can find ETFs that are doing both, then we'll take it. And that's pretty much a starting point for us. Now, what we don't get into too much in this presentation is, money flowing into it and has or has not been performing well is great, but there's certainly a lot more that needs to be done. For example, that technical analysis that I mentioned. Okay, I mean, we may have the greatest ETF in the world, but we certainly want to make sure we're exiting at the right time, and we kind of know where we expect to go and when to, exit and so forth and so on. Right? So we don't get too much into that today, but we will talk a little bit about a market analysis. And to do that, I'm just going to, kind of show you how we've analyzed the market as of late and how it's helped us take part in, say, for example, today's nice up move in the market. All right. That being important because certainly, again, we may like this ETF for any number of reasons, but if we think the market's going to tank or it's going lower, certainly we don't have to be a glutton for punishment, right? And buy something right before it falls off a cliff, right? So again, when we wrap it all up, we'll leave it open to some Q&A from all of you, and we'll wrap it up after that. All right. So let's go ahead and get into it. Talk a little bit about what ETFs are. Again, completely recognize that probably the bulk of you know what ETFs are, but certainly want to be respectful and mindful of those on the call that might not. There's always a few that are like, what is an ETF? An exchange traded fund. A lot of people think of it as, they start off by saying, it's kind of like a mutual fund, right? Kind of, but definitely not the same thing, I guess you could say. It's security that tracks an index, commodity, bonds, basket of assets, like it says. But it trades like a common stock, okay? Like just like any old stock that you might buy, unlike a mutual fund, all right? So you can watch it kind of trade all day long, just like you would a stock. And when you think of buying an ETF, the ETF owns the underlying assets. So whether it be shares of stock, bonds, whatever the case may be, you don't actually, own or have, as it says, direct claim to those assets, but you kind of indirectly own them, as it says. All right. So I always think it's easiest just to kind of, look at ETFs, and it makes a lot of sense. Okay. So for example, here's the big guy, as I like to call him, the spider. All right. Many families of ETFs out there. For those of you that aren't familiar with it, probably one of the more popular ones is the spiders, as we call them, SPDR. And the big guy is the S&P, the SPY, the SPY. All right. And actually, my apologies. Looks like I accidentally put the chart of the S&P on here instead of the spider itself, but they would look the same. All right, let me go take a step forward here and you'll see what I mean. So taking a look at the XBI, all right, this is the biotech, one of the biotech ETFs. You can see at the top where it says SPDR, and that's the spider we're referring to. This is one of within that family. Okay, and this is an ETF that essentially tracks the biotech industry and or sector. Right, so within it, you could actually go pull up the XBI. You could do it, your TradeStation. You pull it up anywhere. I mean, go to Yahoo Finance, whatever you want. You can see the holdings, and you'll see it's a whole bunch of biotech stocks. All right, so it will tend to move as the biotech stocks or industry moves. All right, so this is something where if you not the best stock picker in the world, but you really like biotech as a space, right? And I just don't want to do the research, or I'm just terrible at picking the right guys. Well, you can just buy the XBI, and if you're right about biotech, it should go up, and you make money, right? So coming back to, the SPY, even though this is the S&P itself, again, I do apologize, it would look the same. It would be designed to track the S&P 500, all right? So the same principle would apply. If you just thought the S&P was going higher, you didn't want to pick individual stocks. Let's say you're just somebody that's really good at the analysis of the market, and just maybe not too good at picking individual stocks. Well, I knew the market was going to go up, but every time I buy a stock, it's the one that goes down. Well, you could buy the SPY, and it would be doing what the S&P is doing. All right. Now let's look at the GLD. All right, when you look at the GLD, the gold spider trust, as you can see there, essentially will track gold. Okay, again, keeping in mind that these ETFs wouldn't be necessarily tit for tat perfect, but if you pulled up a chart of gold, you would notice it looks basically the why. Well, let's talk about the benefits a little bit here. All right, less due diligence, could be cheaper, instant diversification, and it allows you to invest in hard-to-access markets. I think when you look at the important ones here, I think first off, let's talk about the GLD and the investing in hard-to-access markets. Okay, gold. Maybe you don't have $1,260, $1,270 to buy yourself an ounce of gold, right? But hey, I want to take part in the rise of gold. Well, the GLD would allow you to do that. So that's what we mean by, the ability to invest in hard-to-access markets. Okay, less due diligence. Again, think about having to research individual companies. Okay, you think retail, maybe you think retail is good. I don't know too many people that think that, but maybe you do, and you don't have to do all the research that the companies and which one. That I just think retail is going up, right? Well, you don't have to do all that due diligence. You could buy the XRT, okay, the retail ETF, right? So makes it a little bit easier on your part. And then the instant diversification. Again, if you buy the XBI, you're automatically kind of diversified across the biotech space. All right, if that makes sense to everyone. So, so when you think about what ETFs are and what they allow you to do, another benefit of ETFs that you could look at is, the fact that when you look at sector rotation. I don't know if everybody on this call is familiar with sector rotation or has looked at a sector rotation model. Here is one of the many you could pull up if you wanted to, but there's the cycle in which the market is kind of in theory supposed to perform as the economy does what it does, right? So if you look at the blue, there's your market going from bear to bull, peak to trough, right? And then you look at the green, which is the economy itself. The market can be forward looking, so you see the market peaking before the economy peaks. You can also see running across the top in the, I guess we'll call that purple, maybe violet, whatever color. You can also see which sectors would be expected to perform best at those stages in the market, whether it be the market bottom, the bull market, the top, the bear market, so forth and so on, right? So if we're gauging the market and you're trying to, do a little bit of sector rotation analysis, and you think to yourself, hey, I think the market is peaking here, maybe that would allow you to start looking at energy, staples, and healthcare. And of course, you could look at, the XLE, the XLY, and the XLV. You can look at these ETFs that will track these individual sectors, and you could obviously move your money into them, right? And again, be diversified within those. So a lot of different benefits of ETFs. But again, that's the basic 411. Again, think of it as giving you the ability to buy a sector, buy an industry, or, again, the hard to access markets like gold or silver, and then of course track the market itself. It makes it pretty easy for you. All right. The ETF market is getting huge. Okay, it's getting bigger and bigger. Seems like every day there's another family of ETFs. There are more ETFs. There's different kinds of ETFs and leveraged ETFs. All right, so it's a very, very big market now, and something that certainly if you are, more of an investor, I can't imagine that you wouldn't be looking at ETFs to be a part of your portfolio. But even as traders, the money cycle is, the ETF money cycle is more of a trading service, certainly not day trading. I would say it's more of, swing trading, but, again, ETFs can be an integral part for us, at least in, taking a part in some of the market moves. All right. So that's ETFs. Now, speaking of the money cycle, we break the money cycle down. Our approach, we make it very simple. I always refer to it as, for those of you that have seen the movie Bull Durham, and you remember when the the manager of the team comes in the clubhouse and starts yelling because they performed horribly and throwing the bats across the locker room and everything. At the end, he says it's a very simple game. You catch the ball, you throw the ball, you hit the ball, right? Well, we liken the money cycle in our 3-step approach to that as well. All right, we have 3 basic steps. Okay. However, I encourage everyone to remember, even though these are the basic steps, I think we all know there's a lot more to baseball than just throwing, hitting, and catching, right? A lot of little details, and we're not going to bog you down with a lot of the. Starts with our what we call our 3-step. One of which, again, we're not going to get too much into today, and that's the technical analysis that we do. What I will tell you that what our members love about our analysis is it's very simple, right? So they understand what we're doing, and so that increases their odds of profiting in the trades, right? What we will focus on today is how we create the list of ETFs that we're going to look for trades on. Okay, and one of those is which we like to take a peek and see if any of the which ETFs have a high amount of institutional money flowing into them or out of them, because yes, a lot of times we're on the short side of the market as well. All right. Now, when we refer to the smart money, these institutional investors, who are we talking about? Well, financial institutions, investment funds, insurance companies, hedge funds, pension funds, yada, yada, yada. It's all these supposed informed investors, right? The ones in the know. Okay, and why might that be important? Well, as it says, they, if they're putting, if they're putting their money, and a lot of it, millions and millions, into specific ETFs and not others, that certainly isn't something that's going to, possibly hurt us, right? It could help us, right? That could cause, these ETFs to rise and or fall because of what they are doing, all right? Now, in no way, shape, or form, okay, is there a direct, hey, if money's flowing in? And you'll see that in some of the charts we're going to look at here. That just because the institutional money is flowing in doesn't mean de facto, hey, it's going to rise. It certainly is a positive, and it's just one of many ways that you could start. right? Some people might start with, I want stocks with a low PE ratio. I want stocks where the insiders are buying. Certainly none of these reasons in and of themselves, I would think, would be the reason to buy, but it's a great starting point, all right? So for us, we look for, look at what are the big institutions doing? Where are they putting their money? All right. So what we did to prepare for this call, we went ahead and did one of our basic scans to see where the money was flowing. And each one of the ETFs we're going to look at, these are ones where from one quarter to the next, the institutional money has increased by almost 100%. All right. And we picked the top 5. All right. So start with the GUNR. Now, I have to admit, when this showed up in our scan, this was not one I had ever looked at before. All right, so I kind of learned a little bit myself. Okay, a natural resources ETF. Okay, this has had a 100%, close to 100% increase in institutional ownership from last quarter to this quarter. And you can see this is a perfect example of what I've mentioned. It doesn't mean necessarily that this is, shooting through the sky right now, but it could be laying the foundation for a nice rally. All right. Again, we would start here. We would look at performance. We'd also do a technical analysis for entry, so forth and so on. But this was the one, number 1, that showed up on our list. All right. The next one right behind it was, the XBI, the biotech ETF. This is one that is on our watch list and has been for a while. We've actually traded a few times. Okay. There's been some times where, the technicals spoke to us when we made some trades. Speaking of, I'm sure a lot of you can look at this right now and look at March and April, and you can see that this ETF seems to run into trouble the minute it clears or hits around $72. All right, 3 different times. Twice in March, once at the beginning of May. Certainly, if this ETF were to rally and break through that, I'm sure a lot of you are thinking, yeah, it looks like a good time to buy. Same thing. You can see it's on its way down to $66. Okay, very important level for the ETF. As you can see, support in April, support in February, resistance back at the beginning of February and in the beginning of January. All right, so that 66 is a key level. So I'm just giving you some insight into some of the basic analysis that we do, okay, before we make a trading decision. However, staying on point here, XBI showed up number 2 on our list, okay? Again, to be honest with you though, all 5 of these, it was basically the same. Dangerously close to 100% increase in institutional ownership from one quarter to this one. All right. Now, look at this one, the XOP, right? The oil and gas. Okay. Money's piling into this thing, but certainly it hasn't been reflected in the ETF yet. All right. So this doesn't right now look like something we'd be too terribly interested in buying. Okay. But a little chart work here and there starts to perform a little list. Okay, watch list. Just keeping our eye on it. All right. Now, the IEFA. All right. This is one that. Whoops, a little typo on my. No, not a typo. Thought I had a typo there. Never mind. That basically, if I remember correctly, is geared around Asian stocks, both small, mid, and large cap stocks, if I remember correctly. Could be wrong, but I think that's right. But anyway, this one, look at the performance. Been performing quite well since November. All right, so something worth taking a peek at. All right, and then the last one on the list, the IYR. Now, this is one, interestingly, that has showed up on our scans. We've done presentations like these once every 1.5, 2 months. And something I've noticed is the IYR seems to show up, repeatedly show up, which is kind of interesting. When you look at its performance, it's kind of meh, not a whole lot going on there. All right, but see a nice good resistance area around 81. We're keeping it on our list. Money's flowing in. If it starts to play a little catch up in the performance category and then pushes up through that 81 area, certainly we could be primed for a trade. All right, so just to give you a little information there are the top 5 ETFs that the institutions are gobbling up out there. All right, they seem to believe these are the industries and or sectors to be in at this time. Whether or not the ETFs reflect it, that's where we do our job in the analysis to wait for that quote buy signal. All right. Now let's take a look at the ETFs that have performed the best this year. All right. Obviously, not necessarily the same thing as we've seen. All right. Let's start with the EWY. This one is on our list. Okay. This is a Korea ETF. So far this year, probably up even more because I did this yesterday, I believe. Maybe even 30% now. I know this ETF was up earlier today when I looked at it, but 30% so far this year. Okay, the top performing ETF, and really don't see any signs to slow down, right? Just been up, up, up and away. And so, let's say you're doing your market analysis and you think the market's going higher, and what really matters to you is I want ETFs that can perform well if the market performs well. Well, of course, you can just buy the market, as we've discussed, right? The SPY, the diamonds for the Dow, or tech's a biggie, or hey, check out the EYW. All right. Number 2 that showed up on our list was EWP, right? Spain. How many would have thunk that one, right? The Spain ETF, right? Up about 26% so far this year. And again, up, up, and away it goes, all right? I have to admit, when this showed up today, I was a little surprised myself, all right, that the Spain ETF was in there. And you can kind of see what I'm referring to. We weren't watching this ETF back in March, but if you look prior to March, you can see how the $28 resistance was pretty clear as a key resistance January, September, almost again back in June. So things we would be looking for on that technical side would have been in March when you see the very beginning we break above that 28. Okay, that would have been our cue. This ETF's probably going higher, right? And that is, I could show you 10 trades or more that we made that looked just like that in the money cycle. All right, where just a simple, good old, clear key resistance point, and we jumped on in. All right, and it's obviously done well. All right, let's look at the next one. MCHI, the China. Now, whether it be this one or the FXI, there's obviously different ones out there. The two of them in tandem seem to show up in our scans one way or another, whether it be performance or the institutional money flow. They seem to be showing up. Now, interestingly, the last time I did this webinar, I remember the China ETFs showing up in the tops of institutional money. This time they didn't. So it kind of makes you wonder, is it set for a decline? Maybe, maybe not. All right. Let's look at the next one, the EPI. Okay, this is one that has been in our watch list for a while, the India ETF. Okay, it's something that, to be quite honest with you, we haven't really looked seriously at trading. Institutional money, when we found it, was flowing in at a decent clip. It had been performing well. Approach short-term trading, one of the things that we've shied away from with this particular ETF is that it's not the biggest mover in the entire world, right? So, but, again, if you're somebody that's wanting to park your money in something like this probably appeals really well, right? Just nice, slow, steady, upward she goes, right? Okay, and the last one that showed up in the performance was the MSCI All Country Asia, excluding Japan. Okay, plus 22% this year. As you can see, just up, 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 and away it goes. This is one that is in our list, if I remember correctly, AAXJ. Okay, been performing very well. And again, when you look at the technicals of it, there are things worth noticing. I notice it rallies and it, bounces on 60 support in March, rallies, bounces on 62, rallies, bounces on 64. Didn't work out on the 66 here lately, but who knows? Maybe if it comes down to 66, take a peek at it. The way it just keeps bouncing on each increment of 2, right? So keeping it simple there. All right. So doing a little bit of a research for you there. If you're interested in ETFs and you like the idea of sticking with ones where money's flowing into them, and you want to know which ones are performing well, there you go. There's the top 5 in each category. This is the first time that I've ever done this analysis for one of these webinars that there wasn't some, cross, back and forth there. We haven't had not one ETF showed up in both of these scans. So interesting this time because usually there's more than one. Now, that doesn't necessarily mean a negative, all right? There's plenty of ETFs out there where money's flowing into them, but they're not in the top 5, right? Or they perform very well, okay? Or maybe they're outperforming the market the past couple months, just not the year to date that I did, right? And this is what I mean when I say you throw the ball, you hit the ball, you catch the ball, but there's a lot of other little details, okay? But the crux of it is, we're looking for some positive institutional flow if we're going long, money coming out if we're thinking short, all right? Good performance. In other words, we want to see that institutional money flow is being reflected one way or the other, okay? Now, once we've done all that, all right, probably our biggest, in the money cycle, we conduct weekly webinars for our members. And the biggest part of that our members seem to enjoy is our market analysis, okay, the breaking down of the market, all right, because we make a lot of our trading decisions based on, of course, what we think the market's going to do. And I was surprised when I first started coaching how often, retail traders weren't even really looking at the market at all, Now, of course, hey, there are stocks that buck the trend of the market, whether it be up or down. But, it certainly is easier to go with the flow than it is to swim upstream. As they say, rising tide can tend to raise all ships, right? So we like to do a little bit market analysis. We like to, know, hey, would we rather be long in this market? Would we rather be short? But again, all that being said, there are plenty of times where, we're short something. We're short the Brazil ETF right now, the EWZ, even though we have a bullish stance on the overall market. All right. So let's talk a little bit about our current market analysis. Now, this is a longer term chart. This goes back 25 years. And this is something that, when you look back at the end of last year, beginning of this year is when we, decided we were going to get, I don't want to say strongly bullish, but, we decided that, hey, overall, the path is up. Pullbacks should be looked at as opportunities to get long unless we see something otherwise, right? And the main reason we were thinking that, again, there are other little things, but we were following this trend line and we've been following it. I've been following this ever since we started coaching. The peak from back in 2007, you can see, follow that blue line. You see we hit that peak a couple times. Been following this ever since, all right? And you can see this trend line is very, very important to the S&P. Okay, if you look back in the late 90s, okay, notice how the very first test of that blue line, resistance, got above it, bounced on it as support 3 different occasions. When we broke below it in the early 2000s, obviously, we were already declining, but it was certainly a pretty good cue that more decline was coming. Notice how we rallied back up and resisted that line repeatedly before going lower. And then 6 years later, multiple times, still paid attention to that line. All right, didn't peak up at 1600 something, didn't peak down at 1400 something, right at that line again. All right, so the market was making it clear, still paying attention to it. Well, look at 2014, 2015. Right, 7 and 8 years later, S&P still paying attention to this line. 2016, you can see we go up and hit it again and pull back, still paying attention to this line. Okay, so what the market is telling us is that this line is important to it. Okay, over a long scale. This isn't an intraday chart here. This is 25 years. And it doesn't matter if you're talking 6 months, 1 year, 5 years, or apparently 8 years. The S&P deems this as important. All right, so you see what happened at the end of 2016. We broke above and held that resistance. Okay, so just back like in the late 90s, we expect to go higher. All right, and that break should lead to a meaningful rally higher. Okay, now there's any number of different analysis we can use to target how far we expect to go. The bottom line is we expect to go pretty far, okay, for the purpose of this call. And if we did pull back and we got a meaningful pullback, as we haven't seen now for like 6 or 7 months, nothing meaningful, okay, but if we assume when we eventually do, we're going to expect to find support at this line, okay, just like we did in the late 90s and early 2000s. All right, so we put our trading first off in the context of, hey, bull market certainly still in force. As a matter of fact, it may have a long way to go, okay, based on this very simple analysis. And I do want to remind everybody Yes, there's a lot more we're looking at. This one chart isn't the end and be all, but I think it makes a pretty powerful statement on what to expect with the market. All right, and so far that has served us pretty well. All right, now let's take a little bit closer look, okay, at what's going on right now. Okay, this is a chart of the S&P 500. Okay, and definitely any number of ways we can do some analysis on expectations and calls we've made, but some of it's pretty simple. I mean, look at December and January. S&P obviously stalling around 2275 repeatedly. You break through it at the end of January, expect to go higher, right? That lets us know it's time to start getting long this market, and it worked out pretty well. Okay, here recently, the last several weeks, we've been talking about needing to see a nice, good, solid hold of 2,400 on the S&P, and we'll look at the Dow in a second, corresponding with 21,000. And Nasdaq's been having a party, right? It just keeps going, but the S&P and Dow hadn't been. Okay, so you can see the 2,400 resistance here in March. You can see it again in April. You can see it struggling all through the beginning of May, right? Not too terribly hard to see why we needed to see that break above 2,400. Now, the S&P had briefly and slightly gotten above 2,400 a few times in May. Nothing meaningful, as I call it, but it had gotten above. But notice how the Dow hadn't during that period of time. Matter of fact, Dow wasn't even hitting new highs, still hasn't. I didn't see where the market ultimately closed today, but I think it's still below its March peak. But you'll notice mid-March, end of April, first several weeks of May, Dow cannot get above 21,000. It's not a one-time thing, it's repeated. Okay, so what we wanted to see, and we've been talking about this in the money cycle and all of our other services and in our coaching calls, that we need to see the S&P break 2,400 and the Dow 21,000 before we can get lean too heavy on the bullish side. Sure enough, last week we broke above and held those levels, rallied a little bit, came back down. What do we tell our members? Hey, if we come back down to 2,400 and or 21,000, we should find support there and go higher if the market's not lying to us. Sure enough, the past couple days, the Dow came down to 21,000, basically 3 days in a row, held it all 3 days. If I remember correctly, today the low was 20,994, if I remember correctly, right? And then we were up at last look 100 and some odd points. We're coming off that level just like we'd expect, right? So notice how it's just some basic analysis of the market. Okay, certainly we can use the inverse type of analysis to let us know, hey, is the market going lower? Maybe some of you can visualize the trend line we might be watching that connects your January low with your April low and your May low. Right? If we break that trend line, that could be trouble, right? So just this basic, and that's all I'm referencing, give all of you the insight into the simple analysis I'm referring to. Okay, we're not pulling up a million different momentum indicators or anything like that. No channels, no bands, no moving averages. Just keeping it simple. All right, and it's unfortunate that so many thousands and tens of thousands of retail traders have been somewhat duped into believing you've got to have all that other technical stuff. You know what? The money cycle is up 200% in 7 months. We're not looking at anything but this price that I'm showing you here, right? Simple isn't always bad. Okay, nobody says it's lesser. Okay, how many of you have heard of point and figure? Good old-fashioned price. Thousands of people all around the world making a living just trading good old-fashioned point and figure. All right, so that's what we subscribe to in the money cycle, keeping it somewhat simple. All right, now there was one thing we were a little bit worried about. Pretty good turnaround in the Russell yesterday and follow through today, so that was nice to see. But we were a little bit concerned about the Russell's inability to hit new highs over the past month. As a matter of fact, we weren't too terribly thrilled that it came back down to that 1350 level. And you can see how important that 1350 level has been.
Hey, Christian, could you check your microphone? It appears you're not projecting right now. Could you take a look at that?
Working tip top, good on my end. Everything. Any chance it's working now? All right, perfect. I was told everything's working, so we shall progress. I apologize, everyone. I have no answers. Everything's showing up as 100% tip-top on my end. So we'll keep plowing away here. So as we were saying before that, little blip, Russell here. We were a little worried about it because we didn't like the fact that it was coming all the way back down. You got NASDAQ rallying, you got S&P hitting new highs, Dow getting dangerously close. But yesterday's turnaround we thought was a pretty constructive day. Just price alone, and sure enough, we got some good follow through. But we do like to look and make sure the market's playing well and getting along, right? So yeah. So when you look at these, again, the analysis we do on the market, we try to keep it as simple as possible. Certainly, like anybody else, we might be paying attention to the 50-day, 200-day, maybe one momentum indicator, but all of our decisions are made on price, and basically price alone. When you think about it, that has to be there. All right. So kind of bringing it to a close here before we get to the Q&A part. What is our overall gist of the call here? Let's talk about the markets. Markets overall, our belief is higher. Kind of showed you why we think that, both on the shorter term and the longer term. Certainly that doesn't mean there won't be pullbacks. Certainly there'll be corrections, but those should be within the context of a higher move. All right, and we, as of right now, we'd be looking at pullbacks and or corrections as time to look at opportunities to get in. Right. When we talk about ETFs, all right, market continues to expand. It's huge. A lot of articles out there these days talking about that. So we feel like we're in the right spot, and we encourage all investors and traders to take a look at ETFs as well. The top ETF from an institutional money flow is the IEFA. When you look at the top performing ones, it was the China, South Korea, and India. All right. So if you really look at what did I gain when I personally did the scans in those two areas, it seems like Asia and even Europe might have been the places to be. I think the EZU was something I think that was the Eurozone ETF, had been performing very well. And so most of what's showing up in the tops of either of those scans seem to revolve around Asia and Europe. All right, so somewhat in the Japan ETF showed up as well. Okay, we've already mentioned China, India, South Korea, right? So Spain, again, I was a little surprised by that. All right, and an extra little nugget here, when we do our analysis, financials are looking somewhat weak. That could definitely change, but if you take a look at something like the KRE or the XLF, you'll notice the performance of those ETFs have not been stellar. All right, now we are watching them because that could easily change, but anyway, so that's kind of the overall the breakdown there. And before we get to some questions here, always like to offer everyone a nice report if you want some more information on ETFs, maybe a little bit more in exhaustive list than what was here. Right here, adamesh.com/TradeStation. You can go download our report. It's basically similar analysis, but I have found 10 different ETFs, and I have cross-referenced ones that are performing well, and money flow is coming into them. So if you'd like that free report, it's free. It comes from the money cycle. So just go to that, the link you see there. Again, adamesh.com. adamesh.com/TradeStation, and I'll take you right there. I think I can put that in the chat box. We'll see. There we go. I think that made it out there to everyone. All right, so we'll go ahead and call it a wrap there and move on to some questions. All right. So let me look back here. I know I had a few questions I saw earlier. Let me go past the ones about the not being able to hear me. Let's see. John, Bloomberg had an article this past month that the number of ETF is now greater than the number of listed stocks. Yes, as a matter of fact, I think Adam just used that same article. He referenced it in one of our money cycle webinars. A lot about that. I mean, the ETF, it's just huge now. Probably the biggest wave in the ocean there. Another question, how do you know when institutional investors enter a security? Well, in a lot of platforms and or sites, you can just do a scan, for when you look for criteria, when you're scanning for stocks or ETFs. One of them, very commonly, is institutional ownership. And so that's all we've done. Now, we do a lot of slicing and dicing, to be honest with you. We do a lot of, we're looking for, a certain amount of liquidity, certain price range, and then, like I said, depending on the time frames we're looking at, that could dictate some of the screening we do, especially in the performance arena. But it's one of the criteria that's usually available on most platforms or financial websites. Let's see. John says Spain's credit spreads have come in tighter and spreads on their bonds relative to Germany and France. Cool. I personally am not really a fundamentals news kind of guy. I kind of look at if something tells me it's going higher technically, doesn't matter to me why, or even if there is a why. Doesn't change the fact that it is. So it's kind of how I do things, but that's probably typical technical analyst. Marin says the NUGT, the nugget as I like to call it, gold ETF, there's a massive divergence between them. I'm trying to, let's see, trying to see if I can make out exactly what you're saying there. The divergence between, I guess you're saying gold and the nugget. I haven't looked at them. I could take a peek. I wouldn't suspect there to be a divergence of any kind, let alone a massive one. Keep in mind, as I'm sure you probably know, that nugget, as we call it, is a 3x ETF. All right. So, I mean, you do have to kind of put that into context, in how it moves. But probably what you're referring to. So, when you look at those 3x ETFs, I'm going to guess that's what's causing the divergence you're referring to. Overall, when gold rallies, without actually looking at them, my guess is going to be, for example, gold's kind of stalled here a little bit over the past couple weeks, a little bit, not a lot. My guess is the nugget has basically stalled. As gold rallied for a week or two in the beginning of May, my guess is the nugget did. But all that being said, keep in mind those 3x ETFs, they're not going to track underlying things the same way the SPY is going to track, the S&P, right? Because of the way they're leveraged. If you think about leveraging something 3-to-1, it's just never really going to line up perfectly. As a matter of fact, it's generally not going to line up very well at all. The overall trend probably would line up there. Let's see. Another question. Are ETFs more effective than stock trading in the sense that they return an equal amount with less risk? It's a pretty good question there. I mean, I wouldn't say that. And I think it also depends, too. Another question here, about what we're trading in the money cycle. We trade the options. Now, I know we have members that when we put on an ETF trade, they are actually buying or trying to short the ETF. But the service is recommending calls and puts. So, that allows us to get this leverage or that, when it comes to, as far as the gains we get. But what I'll say is that when you look at, typically if I buy, one of our ETFs at 30 versus a stock, I'm going to get a much better gain if I'm right in that stock than I am the ETF, right? But because they're not, as volatile pound for pound as stocks would be. Does that mean I'm necessarily taking on more risk with stocks? Maybe a little bit, but I mean, it's relative, right? You're getting a better reward with them. ETFs are, in vogue right now. They're moving around a lot. But at the end of the day, am I going to do any better with ETFs or stocks than the other? Probably not. You know, I think ETFs are. I think they're. I think because of the lower volatility, more often than not, could make them a little easier to trade sometimes. But I don't know. I've been doing this a long time, and it's all potato. It's all a chart for me. But but yeah. So a lot more comments by John. Yeah, thanks. So yeah, getting back to, all right, so question about the money cycle. What is the synopsis of the full contact trading system? Okay, so I don't know if you're looking on Adam's site. The full contact trading is, it's about the, Adam created that 10 years ago, and it was kind of like a basic all-around intro to the stock market. A lot of people love it. Not necessarily linked to the money cycle in any way, though. I mean, completely separate thing. Are inverse ETF effective for profiting from a bear market? Sure. I mean, you could buy the inverse ETFs. You could simply buy puts on, regular ETFs. Either which way. But yeah, that's certainly one way to do it. If you think the S&P is going to drop, you could buy the SH, right? I mean, if you think gold's going to drop, you could buy the GLL. So yeah, you can definitely do that for sure. Another question about the money cycle. Again, the money cycle, the trades that we put on are calls and puts, right? So when we recommend our ETFs, again, long or short, we're recommending, buying the put, buying the call. Again, we keep it pretty simple, but we do the strike and the expiration selection. Our members, I guess in short, our members don't really have to do anything. They get an alert, buy this, strike, this expiration, a little breakdown as to why, and then later in the day we send them a breakdown video. It's usually just a couple minutes, kind of giving them the rationale behind the trade, why we did what we did, right? But once we see the trade, we send out the alert and put it on. Typically, for our track record purposes, we do 10 contracts, but we tell our members, hey, that doesn't mean you have to, or that's by 5. I mean, obviously, portfolio size is a key there. Certainly wouldn't want somebody that has $2,000 to work with, they can take part in the money cycle because they could buy 5 contracts or 2. All right, so there's a tutorial video that comes with the money cycle that everybody, kind of explains all that for everybody. It's kind of, knowing all that. But yeah, so I mean, there's a weekly webinar with it, the trade alerts, and then we manage the position. So we send out alerts when it's time to exit and everything. So for the members, I mean, keep in mind everything you saw here today, we're doing that. So we're finding the ETFs. We're finding the ones with the money flowing in. We're finding the performance, and then we're doing the technical analysis. We're sending out the alerts. All members have to do is just sit back and wait for the alerts. As far as the question here on the performance, we launched that service in November of last year, if I remember. Yeah, it was mid-November. So what is that? About 7 months. And we have run that service as if you only had $5,000 to work with. So we have yet to put on more trades than $5,000 worth. You never have more than $5,000 in the market. Okay, that doesn't mean that's for 10 contracts. So if someone wanted to buy 5 or whatnot. But the portfolio has been managed based on a $5,000 portfolio. All right, that portfolio is now up, and I think I misspoke earlier. I said 200%. We are up at somewhere around a plus 11,000 right now. No, that's right. I was right. 200%. Yeah. So if you add 5,000, we are plus 11,000, give or take a couple $100. I didn't look at the final numbers today. So it's performed pretty well. It's not too actively traded. 5 to 6 trades a month has been our average. Have yet to be in more than 2 trades at once. So it's just you can probably see why our members have taken to it so well. It's very simple. We do everything for them. Not an overabundance of trade, but making a ton of money anyway. All right. So support's a big one. So we provide a lot of support with questions and email support, and we drop phone calls and make sure our members are does no good to have a profitable service if people don't know what they're doing, don't get their questions answered, and can't take part, right? So that is what we pride ourselves on more than anything. So, but alrighty, I think I got all the questions there. And all right, so again, wrapping it up here, I just want to thank everyone for tuning in. Again, right there's the report titled Top ETF for 2017. Pretty simple, adams.com/TradeStation. Download yours. And, and again, I hope to be on here again soon. And Don, thank you for having us. And I really do appreciate everyone in your audience taking the time to hear what we had to say today.